Hi everyone. In this video, we're going to take a look at Upstart stock's earnings call, and we're going to take a deep dive here, and we're going to try to answer the question, what's going on with Upstart stock? The stock is up in the last 5 days, roughly 10%, but if you look longer term for 2022, the stock is down nearly 85%. So let's dig into the details here and let's try and figure out what's going on. So this conference call was held on November 8th, and this is for Upstart's third quarter 2022, and the CEO and CFO are going to be present as well as the company's VP of IR. So let's get into the comments. So the CEO, David Gerard, starts off by saying, our results in the third quarter were certainly not what we wanted them to be, but I believe they reflect the Upstart team making the right decisions in a very challenging economic environment for the long-term success of the company. Of course, the challenging economic environment the CEO is talking about is referring to the rising interest rates in the US and around the world as a result of soaring inflation. And so the combination of these two forces has caused the lenders to pull back on Upstart's lending platform. And so that's caused loan applications, loan approvals, funding, all of those things to come down. And so which has led to a overall decrease in the business's revenue, profits, and all up and down the line poor results for the company. So, and the CEO alludes on this, higher interest rates and significantly elevated risks in the economy mean we're approving about 40% fewer applicants than we would have a year ago. And those approved today are seeing offers about 800 basis points higher than they would have a year ago. 800 basis points higher than 1 year ago. That's significant. That's 8% higher. So if you're a consumer on the Upstart platform looking for a loan, compared to a year ago in the third quarter, you were paying 8% more than you were paying last year. That's a huge jump. And so it's understandable that applications may actually decrease going forward, because when you look at these higher rates, it makes you less interested to borrow money. And then from the lending perspective, lenders are less interested to offer up loans because they understand that the economy might enter into a recession and people might lose their jobs and they might not be able to pay back these loans. And so out of an abundance of caution, they've been pulling back the loans that they are purchasing and offering on the platform. The CEO wants to be clear, contraction in lending volume in a time of rising rates and elevated consumer risk is a feature of our platform, not a bug. This is alluding to what some analysts were saying about the company, doubting its business model, saying that the artificially intelligence infused lending decisions are maybe not as good as the traditional methods, and maybe the whole Upstart business model could be in question here. And so the CEO is saying the contraction in lending volume is a feature of the platform, not a bug of it. So he's saying that this is how the platform is supposed to react when the economic environment turns sour. And so this is the way its platform is supposed to work. So this isn't something that investors should panic about the viability of the business model longer term. This is more of a short-term issue. And in other words, the system is working as intended. Moving on, he says, we've chosen to take a conservative position with respect to the direction of the economy in the coming quarters. In other words, we assume the worst is in front of us. That's good to hear that they're taking a prudent approach to the next few quarters, assuming the recession will be worse than expected and longer than expected. That way, there is a limited downside surprise, and if there's surprise to the upside, oh well, that's good news, right? But what they're trying to do is limit a downside surprise. And in another prudent move, they've been reducing marketing spending in their most expensive acquisition channels. That's good to see. If they're approving less loans and there's less funding, you don't want to spend money to attract customers if they're just going to get declined in their loan applications. Additionally, they eliminated about 140 hourly positions within their loan operations team, representing about 7% of the workforce. Again, I think this is prudent to reduce your staff because you're heading into this volatile, uncertain environment where loan demand, loan applications, all of that is trending downwards. And so you want to operate a leaner company in those times, and saying that they have a healthy balance sheet, robust unit economics, and strong pricing power. Strong pricing power is alluding to the fact that they can charge higher interest rates and charge higher fees on the loans and still get customers to accept these applications and apply. Management is saying artificial intelligence is perhaps the most transformational technology of our time, and risk based industries such as lending are at the forefront, while other platforms continue to retreat to serving super prime customers. Upstart is rapidly learning how to price and serve mainstream Americans in all market conditions. Let me go back to this statement here where management says AI is perhaps the most transformational technology and the lending stands to benefit. This, I just to push back a little, I would say this remains to be seen. Upstart's business model, which is lending based on artificial intelligence, has yet to be proven. And I just wanted to point that out for investors to not say, oh, yeah, that makes sense. Artificial intelligence is cutting edge technology, and it's a foregone conclusion that it is going to benefit lending, and therefore Upstart is going to benefit. That's not a foregone conclusion. That remains to be seen. That is yet to be proven. And so I thought that's important for investors to take note of that. While, yes, there are indications that lending could be enhanced through artificial intelligence, that remains to be seen. And I would argue that in our economy in the US, there is no, I wouldn't say there is a lack of borrowing going on. I don't think that you would say, oh, the US economy would be in better shape if people were able to borrow more money. I don't think that's the case. I think that in general, folks in the US are over leveraged, they're borrowing too much. And so, enhancement through artificial intelligence, while yes, that might lead to better credit decisions, I don't think it should lead to increased borrowing, increased lending. I don't think that would be a healthy outcome. And this is what the second point is alluding to. While other platforms continue to retreat to serving super prime customers, Upstart is rapidly learning how to price and serve mainstream Americans in all market conditions. This is alluding to the fact that people with lower credit scores generally get less loan offers in less favorable terms. And so Upstart is targeting these customers, saying that they are underserved, and Upstart's business model can lend to these folks in a more enhanced manner, which leads to lower defaults, higher approval rates, and higher borrowing, which is a risky proposition, a risky proposition that they're aiming to target these lower credit score customers, saying that they are underserved, that they should have access to more lending, they should have access to more borrowing. And again, I remain skeptical in that regard because I believe that US consumers have too much debt as it is. I don't think that there should be more there I don't think that there should be more work being done to try and increase lending across our economy, if that makes sense. And so I'm a little skeptical to this regard, but I do agree that artificial intelligence could could lead to better credit measurements than the historical models. I do believe that part of it. Although I don't know if that's going to lead to increased lending. That remains to be seen. So this moving on, in the third quarter, they saw a record 75% of loans fully automated. This came from a variety of efforts, including an experiment to help applicants enter information more accurately that led to an absolute 1.8% lift in instant approvals. This is the part of Upstart's business that I am most enthusiastic about. Is this automation of loans? Is this enhancement of the loan process? Not in the overall increase in lending, but the overall improvement in the lending process, because the lending process is so inefficient. So many paperworks to sign, documents back and forth, the long, lengthy processes of underwriters looking at applications, all of the whole process inconvenient and inefficient. And if Upstart can use its technology, its artificially intelligence infused technology, to speed up this process, to enhance the application process, reduce the amount of paperwork involved in the back and forth between the borrower and the lender, sending in documentation, getting it back, signing it, sending it back, adding new documents, copying, checking, all of that whole process takes, I feel, a lot longer than it needs to. And so this is an area I am enthusiastic about Upstart's business model. And it's encouraging to see that they saw a record 75% of the loans fully automated. That's encouraging because this also reduces costs in the process too. If there's less documents going back and forth, if there's less human involvement, that means fewer humans need to be paid, and so that could increase the profitability on a per loan basis. More than 1 in 3 auto loan applications were automatically verified, double from the prior quarter. Again, encouraging to see. The business saw 9,000 small dollar loans on the platform, almost 4 times the prior quarter. This one, I don't know if it's really encouraging, the fact that they're lending out smaller loan amounts to a broader base of customers. You could think of it as, yes, it is, because it diversifies their loan base and adds new customers to their platform, and hopefully over time these customers pay back their loans in full, and then as they grow with Upstart they increase their loan amounts. But at the same amount, it could mean that there is more loans that are not backed by collateral, right? The auto loans are backed by collateral. If a customer misses their car payment, the company can repossess the car and so recover some of the loan amount. The smaller loan amounts are more likely personal loans, which are usually not backed by any collateral, and so the defaults are you know lead to bigger losses. And so a give and take, whether it's good or bad. They deployed a record 17 new lenders on the platform in the third quarter, including Alliant Credit Union, which is a top 10 credit union by size. That compares to 17 lenders launched in all of 2021. So that's good news that they're bringing on partners on the platform that are joining, signing up, and starting to develop a relationship with Upstart. Because remember, Upstart's main goal is to have like a marketplace business model where it brings together borrowers and lenders and earns a commission for bringing them together, using its using its algorithm, its data intelligence system to make loans, and in that way make fees in a less risky process, instead of Upstart using its own capital to lend to customers. So bringing on outside lenders is a critical component of its business model long term, and this is encouraging to see. As of today, they have 83 lenders under contract, on the Upstart platform. As an investor, you want to see this grow. All right, moving on to the CFO, who talks about the personal saving rates from pre-pandemic levels of roughly 9% are down to 3.3% in the third quarter, a level not seen since the great financial crisis, and have swelled credit card balances to all-time record highs. This speaks to what I was saying earlier in this video, in that consumers are overall borrowing too much and not saving enough here in the US. And I don't think it would be healthy to see an increase in borrowing levels, especially now that we're we're removed from fiscal stimulus checks that went out into consumer bank accounts a little over a year ago. And you can see through this statistic that the saving rate is down 3.3%, is that consumers are spending down their savings and dwindling them down and raising credit card balances. This is not good news looking at the health of the US consumer. The third quarter environment produced 70% more defaults than they would expect from their borrower base in a long run normal macroeconomic environment. This is 20% higher than they observed when they last reported earnings in August. This is big news here in that the third quarter, 70% more people defaulted on their loans than they would expect in a normal economic environment. So we're already in the Upstart is already experiencing very poor consumer behavior in their loan payback rates, right? 70% more defaults than normal, which was a quarter over quarter, it got worse, 20%. And so the conditions have not materially improved, and there is no expectations that they are going to improve. So the credit quality and the payback rates, it appears, are only going to get worse for Upstart going forward in the short term, right? I'm not speaking longer term here. As a result, their model adjusted to these macroeconomic conditions, and they increased their loan rates, and which are significantly higher from the beginning of the year. Loan funding in general remains challenging. So not only did they increase the loan rates, but their partners are not lending on the platform after they're observing, hey, look, people are defaulting much more on their loans. Of course, I don't want to lend during a time when people are defaulting 70% more than usual. That's an understandable pullback. In the third quarter, they made approximately 188,000 loans, which was down 48% year over year, representing 125,000 new borrowers, and the average loan size was up 14%. So fewer loans, but each loan is increasing in size. And I'll end with the discussion on expenses. So, of course, as Upstart sees its business conditions deteriorating, the top line growth is going to get worse, loan losses are going to get worse. It's prudent for them to decrease expenses, and it's good to see that Upstart is working on decreasing expenses. Operating expenses of $215 million in the third quarter was down 17% from the previous quarter. They reduced their sales and marketing by 40% from the previous quarter to reflect this weakening of the economic environment. That's good to see. That's prudent management there from the company, starting to lower their expenses. And then they're saying they have a favorable liquidity position. They have $830 million in total cash and $431 million in net loan equity on the balance sheet. So they have a healthy amount of cash. The near-term outlook for the business remains tied to the direction of the macro economy, which the direction is bad. The direction of the macro economy is bad. There is no sugarcoating it. There is rising inflation is causing Federal Reserve to increase interest rates, which is causing a general slowdown in sectors that are sensitive to interest rates, like housing, like car sales and car loans, which Upstart stock is incredibly sensitive to changing interest rates. So its business is incredibly sensitive to the rising interest rates, and interest rates are expected to continue to rise in the near term as the Federal Reserve has indicated that they are going to continue raising interest rates. Okay, so that's all I've got for this Upstart stock deep dive into its earnings call. Hopefully, I've highlighted a little bit more about what's going on with Upstart stock, why the stock is down so much in 2022, and we can start to understand why. The macroeconomic environment is not looking favorable. Upstart's business is very sensitive to changing interest rates, and that's working against it in the near term. All right, so if you've gained any value from this video, please go ahead and hit the like button. It'll help me make more videos like this one. And I will see you next time. Thank you for watching. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.